Imagine waking up one morning to realize the $100 bill in your wallet has been shaved of its value without a single hand touching it. On the digital boards of the Toronto Stock Exchange, the loonie is in freefall, creating a black hole that sucks away the purchasing power of the middle class. The alarm doesn't sound with a siren. It creeps in through soaring prices at Shell stations, surreal grocery bills at Loblaws, and the haunting silence of the real estate market. As the national currency weakens against the greenback, Canada isn't just facing a routine exchange rate fluctuation. It is witnessing a flight of capitular grim litmus test for a resource-based prosperity. Are we seeing a technical correction, or is this the opening chapter of a systemic collapse, where a developed nation's complacency is crushed by the ruthless laws of global cash flow? What you are about to hear aren't just lifeless numbers on a Bloomberg terminal, but the story of how your hard-earned wealth is evaporating in a volatile new economic order. The first signs of the storm didn't appear in major headlines. They emerged in the drying up of liquidity in the bond market and a spike in credit default swaps (CDS). As the cost of insuring public debt rises, international investor confidence begins to fracture. At ports from Vancouver to Halifax, imported goods become irrationally expensive, while local businesses feel the squeeze of input costs. This is no longer a forecast. It is the reality of a CPI that consistently outpaces expectations, trapping citizens between stagnant wages and a rising cost of living. Global economic history is littered with such tragedies. Look at the 1997 Asian financial crises, where the IMF had to intervene after speculators tore through the tiger economies. Or, more recently, Turkey, where hyperinflation turned lifetime savings into scrap paper in mere years. Canada, despite its solid foundation, sees its structural vulnerabilities rooted in debt and real estate exposed as foreign capital flees for the safety of the US dollar. The mechanics of an economic shock always begin with the domino effect of trust. As the Canadian dollar weakens, the Bank of Canada BARC faces a dangerous dilemma: raise interest rates to protect the currency at the risk of strangling an overheated housing market, or keep rates low to stimulate growth while letting inflation erode purchasing power. This is the liquidity trap that has ensnared many nations before. When real interest rates turn negative, smart money doesn't stay. It flows back to US denominated assets, putting massive sell pressure on the loonie. Consider lessons from Argentina or Venezuela, where losing control over currency value led to a de facto loss of economic sovereignty. In Canada, importing inflation via US goods means every meal and every liter of gas carries the hidden tax of a weak currency. This imbalance creates a downward spiral. A weak currency leads to high production costs, reduced competitiveness, widening trade deficits, and further downward pressure on the currency. It is a financial maze where the exit becomes increasingly expensive for every household. To grasp the severity, we must weigh Canada against global benchmarks. In 2010, Greece's lack of monetary control within the EU led to a lost decade. While Canada has its own currency, our tight integration with the US financial system subjects us to the same pressures faced by emerging markets when the USD reigns supreme. In developing nations, a 20 to 30% currency swing is a catastrophe. In a G7 nation like Canada, a mere 10% drop is enough to upend national fiscal plans. Turkey's unorthodox monetary experiments show that once trust in a currency vanishes, restoring it requires decades of austerity. Canadians, long accustomed to stability, now face a reality familiar to citizens in Brazil or Russia. Your net worth isn't determined by your hard work, but by your nation's standing on the global financial map. This comparison isn't meant to incite panic, but to recognize that no fortress is impregnable against the waves of speculation and the geopolitical shifts of the world's reserve currency. The direct impact on the Canadian economy is most visible in the double punch to real estate and household debt. Canada currently holds one of the highest household debt-to-income ratios in the world. When a weak dollar forces the central bank to maintain high interest rates to curb imported inflation, the debt servicing burden becomes suffocating. Mortgages coming up for renewal at double or triple their previous rates are turning the dream of homeownership into a decades-long financial shackle. The construction sector, a primary growth engine for many provinces, is stalling as the cost of imported materials skyrockets alongside the USD small and medium-sized enterprises. The backbone of the economy are forced to cut staff to offset rising operating costs. The currency's decline also devalues pension funds and net assets when measured in international purchasing power. We are seeing a deepening wealth gap. Those holding real assets or earning in foreign currency stand firm, while the working class earning in CAD finds themselves relatively poorer compared to the rest of the world every single day. The response from the government and the Bank of Canada during this period is akin to navigating a massive ship through a narrow strait during a hurricane. On one hand, the Ministry of Finance attempts to roll out support packages to soothe public anger, but injecting more cash into circulation while supply is constrained only adds fuel to the inflationary fire. The Bank of Canada is forced into hawkish rate hikes, accepting the risk of a recession to defend what value remains of the currency. However, their power is limited. In a world where the US Federal Reserve, the Fed, holds the power of life and death over global capital flows, the BOC can only react defensively. If they don't match the Fed's rate hikes, the loonie will be sold off even more aggressively. Currency market interventions are often short-lived and exhaust foreign reserves. History shows that if fiscal policy, government spending, and monetary policy's central bank are not aligned, a nation falls into stagflation, an economist's worst nightmare, where prices soar while the economy fails to grow. In this financial storm, individual survival strategies are no longer optional, they are mandatory. First, restructuring asset portfolios is a top priority. Savvy Canadian investors are shifting a portion of their capital into internationally liquid assets or multinational corporations with USD revenue to hedge against CAD depreciation. For households, cutting consumer debt and prioritizing the accumulation of cash or hard assets like gold has become the final shield. We must learn to view the cost of living through the lens of global purchasing power rather than nominal figures on a bill. Diversifying income streams, such as seeking freelance work paid in foreign currency, is becoming the new trend among youth in Toronto and Vancouver. Economic survival in an era of volatility doesn't rely on hoping for government bailouts, but on the ability to forecast and adapt. Remember, in every currency crisis, wealth isn't lost, it is simply transferred from those who are unprepared to those who understand the rules of the game and know how to protect their labor from the erosion of the exchange rate. Looking deeper, the weakening of the Canadian dollar is a mirror reflecting internal economic flaws. We have relied too heavily on raw resource exports and a housing market inflated by debt. When oil prices fluctuate and global demand shifts, the currency loses its bedrock. This is a costly lesson in the need for economic diversification and investment in technology and innovation rather than just wealth in the ground. Nations that succeed in maintaining a strong currency typically possess high-value-added manufacturing and transparent, low-risk financial systems. Canada is at a crossroads. Either continue accepting the status of a dependent economy vulnerable to every USD fluctuation, or undergo a painful reform to restructure the foundations of its prosperity. The loss of purchasing power is not just a financial issue, it is a decline in national influence. Every cent the Canadian dollar loses is a part of our voice at the global bargaining table that grows quieter. This awakening, though late, is necessary to build a sustainable future where prosperity isn't built on fragile bubbles of debt and speculation. The ultimate message we must realize is this: currency is more than a medium of exchange. It is a symbol of national trust and strength. When that trust is shaken by negative economic indicators and rising public debt, the echoes last for generations. What we are experiencing today will become chapters in future economic textbooks, much like how we study the Latin American debt crisis or the collapse of the Bretton Woods system. The weakening loonie is a stern warning that we cannot sustain a lifestyle beyond our actual means forever. However, within every crisis lies the opportunity for reconstruction. Market purification will weed out weak business models, force individuals to become more financially astute, and compel policymakers to face the truth. Canada's true strength does not lie in oil reserves or housing prices, but in the resilience and adaptability of its people. Navigating this volatile period requires a cool head, long-term vision, and thorough preparation, both financially and mentally, to avoid being swept away by the current of devaluation. Asterisk. We have journeyed through the macro and micro layers of the storm known as the weak dollar. From the ticking tickers on Wall Street to the expensive grocery receipts in every Canadian kitchen, everything is part of a global economic web of complex interconnections. The money in your hand today might not buy what it did last year, but it offers an invaluable lesson in financial sobriety. Will we choose to stand still as the tide of inflation washes over us? Or will we proactively change our mindset to master our financial destiny in a world where nothing is certain? This crisis marks the end of complacency, but also the beginning of a new chapter of economic understanding and maturity. As the lights of the stock exchanges dim and the numbers temporarily stop their dance, the real question remaining in everyone's mind isn't where the Canadian dollar will land against the USD, but this: if tomorrow every number in your bank account suddenly lost half its real value due to exchange rate volatility, would you have the knowledge and the resolve to start over on a firmer foundation?